Government's June jobs report just out, showing a gain of 224,000 positions added to non-farm payrolls. The unemployment rate at 3.7%, a lot better than had been anticipated. But take a look at where the markets are right now, because in this sort of perverse, the world's upside down situation, good news is bad news. What does the Fed do about all of this? Now there's some concerns maybe the Fed won't move as fast as it had been expected. Dow off about 100 points, NASDAQ off about 49 points, S&P 500 off close to 14 points. Let's take a quick look at the dollar and the 10-year as well. We're going to flip the board around for you so you can see what's going on there. The dollar 97.21, but let's show the 10-year right now, because I think that's what most people are going to be focused on at this very moment. We should probably show some Bitcoin, too, by the way, and some gold. But, yeah, exactly. Broke 2. So we're over 2 now.
All right. For insights on how those payroll numbers could play on the markets today and what they could mean for the Fed later this month, let's bring in Tim Kearney, asset allocation strategist at Voya Investment Management. Tim, great to have you with us.
Thank you. Good morning.
What was your view of the July cut from the Fed, and does it change? Has it changed with the release of these numbers?
My view was we were not getting 50 basis points. That was the market was well ahead of itself. The July cut, I think, can be justified on inflation grounds. They want to hit their target or go above it even. And as someone on the panel earlier mentioned, it's kind of hard to disappoint the market after all this lead-in. I do think that the Fed's communication may have added a little bit of uncertainty, taking out patience and trying to figure out what they're up to. I expect they will cut unless you get a big inflation print. But as they said, let's not overanalyze any one given number. So,
do you think that this number, this June jobs number, reduces the chance even that the Fed cuts by 25? And I asked you that as we watch futures weaken after this report.
You'd have to think so. Number was pretty good. 174,000 on the 3-month average is below the 12-month, but it's better than last month. That's a little bit of bean counting, I'm afraid, as opposed to good, solid monetary policy.
Would your allocations change if you knew today that the Fed wasn't going to cut rates?
We're set up with the idea that the market is over-anticipating over the course of the next 12 months rate cuts, so I don't think we would.
Over-anticipating, you said?
Oh, too many rate cuts, yes.
Too many rate cuts, yeah.
So I'm looking at the Fed funds futures contract. So we've lowered the probability, but only 50. We've basically taken 50 out, but 25 is still basically 100% priced.
Right.
So it's going to take a lot for them not to move at this point. And maybe they just give you 25 and the statement says, look, we're going to be cautious. They won't put patience back in,
if that's all they move,
well, then the market's going to back up. And the problem you have is, this is the other thing we need to talk about. I mean, the yield curve in the U.S. is basically totally inverted, and markets tend to sniff things out before economists or data do. And I don't want to fall back on the notion that employment generally is lagging, but essentially it is. Tim made a great point about inflation. Inflation's undershot. They've got reasons to ease. And by the way, you're 72 2 months ago, 224 this morning. If next month you're back at 80 or 90, they're cutting again in September.
But 25 is happening.
25
anyway.
is happening.
And but the markets, they're pricing it at a higher, they're expecting
they're
more
pricing
than that.
over the next year. That's correct.
Yeah.
So,
in terms of earnings season, Tim, what are you expecting out of earnings season? What are the areas that could I don't want to say overshoot, but could beat expectations?
Generally speaking, I think the manufacturing sector has been hit so much that maybe there's a little upside to that.
Yeah. How about technology, since it's so important to the markets overall as a percentage?
You'd like to see technology always do well. I don't have an expectation on earnings season, though.
Okay. You're just not looking for it? I mean, you don't have a specific forecast, or you're not expecting
We're
much?
We're in the midst of kind of digging that all out.
Okay. Joe, do you think that earnings season will play a role into, earnings season? No,
because I think.
what happened in September and October? Earnings season played a direct role, right, in the pivot of the Fed.
Here's what I would say. I know it sounds like I was being hyperbolic with that comment, but the guidance matters more. And this is why, when you look at Duke's Fuqua School does a great survey, CFOs, what they're planning on doing. So the expectations, the guidance, that to me is important. Not the earnings, for the reasons we've talked about, is that, for lack of a better term, companies can massage those estimates. But where are we going? And the issue is, look, we are still decelerating. That's the key point, and we're decelerating in a world where inflation's consistently undershot its target. And central banks have relied, unfortunately, on propping up asset prices to bring about growth. And the problem is every time the market corrects, the Fed's in this uncomfortable spot of feeling like it has to do more to try to keep those assets elevated. But the earnings won't matter as much as what companies say.
Well, I mean, I guess that's what I mean. During earnings season, we get the conference calls, we'll get the outlooks.
Yes.
And this will mostly happen. I mean, a big percent of the S&P 500 will do that before the next
Right,
meeting.
but I like your point earlier when you said that companies are going to use trade as an excuse for everything. We didn't talk about China. China's been slowing for the last couple of years. They're trying to offset that. Growth has been weak. It's not just been a trade story, but the global economy's been soft. So companies are taking the advantage of just using trade, I think, as an excuse. It's a free option. Take it.
Yeah, why not? I mean, how could you not? Do you expect a lot of excuse making during this earnings season in the conference calls?
Yeah, I tend to agree with what Joe said. The trade is top of mind. It's what's driving, I think, the manufacturing globally lower, and it'll take a little bit to figure out the ultimate impact. I will say on trade, the companies are and the economy are going to still be worried. I mean, trade is still out there, and the Fed, the U.S. can always just ramp it back up. And so I think what happened recently is positive, but this is a little bit of an issue still out there.